Hello everyone, this is Ayman Ali. Today we'll be discussing the Chapter 2, Accounting Equation and the Statement of Financial Position. So what is the accounting equation? The accounting equation includes all the ownership of the business. What does the business own and what does the business owe? So any resources of the company is considered a business ownership, and we call it an asset, which is the resources which are used for a business purpose and used for the business activities and operations. So how do the company or how do the business get these assets or these resources? Through financing through other suppliers who are supplying the company with the goods, or supplying the company with the raw materials in order to make the production. This is the first source of supplying or financing the company. The second source, which is the main source, the capital, is considered the owner's equity or the net worth for the company, which represents the owners. How much do they invested in the company, and is the company in a profit status or in a loss status? So assets is considered are the resources which are used by the business as a part of the activities of the business, such as, let's say, for example, property, equipment, and cash. So anything you could consider you own it, so it is considered a cash. Okay, what about liabilities? Liabilities represents the debts of the business, which is represent the debts to the suppliers or other parties who are engaging with the business for the activities, suppliers, bank loans. These all considered liabilities. So last one is the capital, which is called owner's equity, which refers to the resources supplied by the business owners. When we are talking about the business owners and their activities in the business, so we call it, we are talking about the capital. And now we are going to the next step. We have already discussed that the assets will be equal to capital and liabilities, which are the resources you own equal to who supplied the resources. So how do we represent the accounting equation in a financial statement? Financial statement called the Statement of Financial Position, which represent the financial position of the company at a particular time. So it represents a screenshot for the business. What do the business own and how much the business owe at a particular date or particular time. So it is a screenshot. Okay, the first classification, we make a horizontal form, something like a T account, a T shaped. At the left is the assets, at the right is the owner's equity, which is capital, and the liabilities. We have already agreed that the assets should be equal to the sum of owner's equity plus liabilities. Okay, so the left side should be equal to the right side. The left side, the assets, is classified into two categories. The first category is the non-current asset. Non-current assets is the assets which are held for more than 1 year. So let's say, for example, if we're talking about a building, premises, land, motor vehicle, cars, furniture, machinery, equipment, all those are considered our non-current assets, which cannot be converted into cash or cannot be liquidated within 1 year. Okay, what about the current assets? The current assets are the assets that will convert into cash within 1 year. So let's take, for example, inventory. Inventory are the goods that you have bought or the goods you own in order to sell it. So if you have some goods within a particular date, so you are going to sell it within 1 year maximum. Okay, second example for the current assets are trade receivables. Trade receivables are the amount generated from sales, credit sales to the customers, which is the credit customers, the customers who bought goods on account or on credit. They are going to pay later. So they are going to pay within 1 year, so the trade receivable will be cash within 1 year. Other receivables are other kinds of receivables, such as prepayments. If you have paid a prepayment for something, so you are going either you are going to receive this service within 1 year, or you are going to take back your money or your prepayment within 1 year. Cash at bank and cash in hand is already a liquidated asset, so no, don't need to discuss it. On the right side, the liabilities. The liabilities are classified into two parts: current liabilities and non-current liabilities, the same as current assets and non-current assets. Current liabilities are the amount payable within 12 months or within 1 year, such as bank overdraft. Bank overdraft is something you are taking instantly, an instant loan, or just you are having a negative balance. Current liabilities is something that you're going to pay within 1 year. So bank overdraft is a negative balance to your current account, so it's going to be paid within 1 year. Trade payables are the money owed to suppliers, those who have sold me raw materials or goods. I'm going to pay them within 1 year. Other payables, other kind of debts on the company. Non-current liabilities are the liabilities or obligations that I'm going to pay more than 1 year. Last thing we have here is capital. Capital represents the contribution of the owner in the business. So how we calculate the capital? We're taking a capital opening, which is the beginning balance for the capital. We were going to add any additional investment that happened, plus or minus profit or loss of the year, whether you have made some profits or loss, and whether and then we deduct any owners with drawings. Something like if you have an owner who came to the company and then asked for to draw, let's say for example $2,000, so we're going to deduct this, all balancing at capital balance. This is the vertical form for the balance sheet. It also represents, first we have assets classified into non-current and current, then we have capital, and then non-current liabilities and current liabilities. And these are some examples. You can go through it. Please, if you have any questions, don't hesitate to ask me at any time. Thank you.